Hi, I'm Lindsay from KOSEC Kodari Securities, and today I'll be discussing return on equity, or ROE. It's one of the key fundamental metrics utilised by KOSEC as part of our evidence-based investment strategy. And it's one of the most important return metrics for equity investors to consider. As always, all information given is general in nature and does not take into account your personal needs or objectives. For further information, visit our website www.kosec.com.au. So today, we'll provide an overview of this financial metric. We'll then explain how it's calculated, and finally discuss why it's important to equity investors and provide some practical examples from companies listed on the ASX. So how do we calculate return on equity? ROE is calculated by dividing net income by shareholders' equity. This will be expressed as a percentage and can be calculated meaningfully for any company if both net income and shareholders' equity are positive numbers. The numerator, net income, is calculated by taking revenue, then deducting variable and fixed expenses, depreciation, interest, and taxes, while the denominator, shareholders' equity, is all shareholders' residual claims on the company's assets after debts have been paid, and is calculated as total assets minus total liabilities. Now we can actually decompose the ROE calculation further into three separate components, known as the DuPont analysis. This formula breaks down return on equity into its profitability, measured by its net profit margin, its asset efficiency, measured by its asset turnover, and its financial leverage, measured by its equity multiplier, which increases with a company's level of debt financing relative to equity financing. An increase in one or more of these components will lead to an increase in ROE. So why is ROE important? Essentially, it measures how effectively or efficiently company management is utilizing shareholders' equity to generate income or profits. Clearly, if net income or profit is higher, then this is a great sign of a well-managed company. But additionally, all else equal, if less shareholders' equity is required to generate that profit, this means that there are more earnings per share to either reinvest in the business or pay out as dividends or distributions. All of this means that ROE can be a useful starting point for estimating sustainable growth rates and dividend growth rates. Now, in general, a higher ROE is better than a lower ROE. However, a caveat should be observed when interpreting ROE figures. A very high return on equity could be due to a very low equity base and/or high level of debt, both of which could indicate a high level of risk. As mentioned earlier, the ROE calculation is only meaningful if both net income and shareholders' equity are positive numbers. By the same token, the ROE calculation is far less meaningful if shareholders' equity is artificially low, either due to prior sustained losses or a high debt-to-equity ratio. It's also important to keep in mind that what constitutes a normal or good or bad ROE is very much dependent on the particular industry or sector that the company is in. For instance, a normal ROE for companies in the energy and utility sector might be less than 10%. This is because they tend to be quite capital intensive and thus require a higher capital base for their operations. For instance, in the 2019 financial year, Origin Energy had an ROE of 8.9%, Infigen Energy had an ROE of 8.7%, while Oil Search had an ROE of just 5.8%. In contrast, a normal ROE for companies in the technology or retail sector might be more like 15 to 20%. This is because they're able to operate with a smaller balance sheet. For instance, in the 2019 financial year, JB Hi-Fi had an ROE of 23.9%, Kogan produced an ROE of 33.7%, while Apple Inc., which is listed on the NASDAQ exchange, managed an ROE over 50%. So in summary, this means that a meaningful analysis of ROE should involve a comparison with the company's industry peers, as well as analyze whether it's stable, trending up, or trending down compared to the company's historical performance. So in this video, we provided an overview of the financial metric return on equity. We explained how it's calculated and also discussed why it's important to equity investors and provided some practical examples from companies listed on the ASX. So I hope you found it helpful. This video was brought to you by KOSEC Kodari Securities.